Let's talk about the alpha of a portfolio strategy. Suppose that I construct a strategy based upon a regression selection technique of individual stocks or some sort of sorting strategy where I've got a portfolio that's long and a portfolio that's short. And the spread between the returns is, say, 12% per year. And when I try to evaluate the risk of that strategy, it turns out that the portfolio that I'm long has a beta of 1, and the portfolio that I'm short has also a beta of 1. So when you take the difference between the returns of the two portfolios and take that spread return and regress it on the market return, you get a beta of 0. A beta of 0, but an alpha of 12%. Now, the question is, does this mean that the market is inefficient? Now, the first thing that we need to realize is the market is inefficient. It's inefficient by construction. We know that information is not instantly and perfectly reflected in asset prices. So the real question is, does this indicate that there's really pervasive and gross market inefficiency? Now, there's a number of reasons that we might get an alpha of 12%. It is the case that the average beta of this portfolio could be 0. And that's what the regression tells us. It means that this portfolio is not correlated with the market as a whole. But does that mean that the abnormal return, risk-adjusted, is 12% per year? And this really has to do with two levels of subtlety. The first level is the risk constant through time? And second, what is the risk? Now, we've talked previously about dynamic risk functions and risk shifting through time, and how a market timer might appear to have a positive alpha, but if you account for the shifting of risk through time, the alpha might be reduced. But now what I want to talk about is something a little different, in that it might be that we've got the measure of risk incorrect. So it might be that if we examined a multi-risk type of model, and instead of regressing my portfolio return on the contemporaneous market return, I include some other factors. And these factors might be things related to changes in expected inflation, interest rates, term structure, economic activity, variables like this. Multi-factor type of model that reflects the general risk factors in the economy. It might be, when we actually do this on our portfolio, that we still have a beta against the market of 0, but significant sensitivities to some of these other factors. And when we run this multiple regression on the market and these other factors, it might also be the case that the alpha is substantially reduced or goes to 0. Now, what does this mean? Well, it means that we've got these two portfolios, one were long and one were short. We thought they had identical risk, but that's not the case. They've got identical risk with respect to the market, but they have different risks when we start looking at these other factors. So indeed, if the alpha does disappear, it suggests that because one portfolio has a higher risk exposure to some other factor, that it should get a higher expected return. That's exactly what you would expect. You load up on a particular source of risk, and you're going to get a higher expected return. This has nothing to do with alpha. It has to do with adjusting the returns for the types of risk that the strategy actually bears. So you could do this two ways. We could look at the portfolio that you're supposedly investing in, the long portfolio, the buy portfolio, and we could look at the portfolio where there's a short investment, and we could see that the risk loadings on those two portfolios differ. Alternatively, we could just take the spread between the two, the so-called spread portfolio. And we could, again, run this regression, and this is where we would expect to see the beta on the market to equal to 0. But the beta of the spread portfolio on these other risk factors could be non-zero. So let's put this in perspective. If I'm an asset manager and I'm evaluated against a simple CAPM, then indeed there's an incentive for me to undertake the strategy whereby I set my market risk equal to 1, or a spread portfolio such that it's got 0 market risk, and load up on some other factors that are rewarded. So I could take a strategy of taking a portfolio that's exposed to, let's say, inflation risk. And when I'm evaluated, I'm going to be rewarded for that in the following sense. I get, according to the CAPM, a positive alpha. But all I've really done is taken extra risk that is not included in the CAPM. So there's always an advantage to being evaluated with the simplest possible model. But as somebody that is kind of on the other side of this, if you see some portfolio manager who comes in and claims to have a very high alpha and a beta of 0 in the spread portfolio, then you got to ask the question, what sort of risk is this person actually taking? So I would want to do the analysis, to run the multi-factor model, to see what sort of risk exposure the securities this investment manager is actually exposing themselves to. I'd want to know that for sure. And do they provide performance that is over and above what you would expect in terms of the risk? No. In this case, there's no alpha. Now, I should also mention that if there is true ability to select stocks, then if you're evaluated against this multi-factor model, there still could be a positive alpha. And I would be impressed with that. Would this suggest that the markets are inefficient? Again, I think that the markets are inefficient, but we need to be very careful here. Even though we've specified a multi-factor model and we think that we've captured all the risks, it might be that we haven't, that there's some factor that we've ignored. And it might be that the investment manager doesn't even realize that they're exposing themselves in terms of the portfolio to a particular type of risk that we're not measuring. So we have to be very careful about this, that the way that people are evaluated sometimes determine the sort of strategies that they undertake. And we have to kind of go beyond the simple CAPM. We have to look at a more general version of risk.